Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update, get you up to speed on what is going on in the market. I'm also going to cover what we see that's going to happen with inflation and the official inflation rates, which will affect everyone's Social Security checks and pension payments going forward. And we're also going to talk about Kamala Harris. At last market update, I talked about Trump's economic plan. We're going to talk about some of the economic proposals that she has and what I think about them. So stick around. We're going to cover a lot of stuff, including some of the new investment products that are out and what the current interest rates are, and some exciting new things that we're seeing. We have a new product coming out next week that I'm very excited about. So that and more in this market update. First, let's cover what we see with the inflation numbers. As many of you know, the way that the government calculates inflation is based on the federal fiscal year, which runs from October 1st to September 30th. And whatever the inflation rate is in September, that's what they use to increase everyone's Social Security checks and everyone's pensions and all of these different things that are impacted by CPI. This is the number that is used, and it's a big deal, especially for retirees that are collecting a lot of income from Social Security. We do have an idea of what those numbers are going to be. There's several groups that publish what their expectations are ahead of time based on looking at all the data and what they expect. We won't have the official number until later on, a few weeks from now, but it looks like the number is going to come in between 2.5% and 2.7%, somewhere in that range. Now, I know many of you are saying, wait a minute, inflation is only 2.5% to 2.7%. That's ridiculous. I go shop at the grocery store. There's no way inflation is that low. Well, the government does a lot of adjustments. They use hedonics, they use all kinds of substitutions and things on the CPI index in order to try to make that number look a lot lower. And so even though this number may not be entirely accurate, it is the number that is going to be used to show what people are getting in Social Security, the increase in their payment, and also in pension, especially government pensions. That is the increase that is going to be applied. Now, as far as the economy, I am getting more and more worried about a recession. And this seems to be the opposite of what we're seeing from the media and Wall Street, that everything's great and that we had this soft landing, we're going to avoid a recession. And I just don't see that in the data. In fact, one of the big worries is that the yield curve just uninverted. The yield curve that is typically used to look at the data and determine when the recession might start is the 2-year and the 10-year, which has been inverted for quite a long time, in fact, a record amount of time. It briefly uninverted back in July, but then it did not close uninverted. It was still inverted at the close that day. And just recently, September the 4th, if you put that on your calendar, mark that September 4th, that's the day the market actually closed uninverted. That means the 10-year yield is higher than the 2-year yield. Now, we still have a higher interest rate on a 2-year than we do, say, for shorter duration, like 5 years, or 7 years. But on the 10-year rates, we are definitely seeing a higher interest rate on the 10-year than we are on the 2-year. And this is a bad signal. Typically, if you look at probability, it's about a 90% probability that a recession is going to start, and it'll become obvious in the next 3 to 6 months. Now, the recession may have already started, and as you know from previous videos, I was targeting June of 2024. I mentioned that as far back as the summer of 2023, that I thought that June of 2024 would be the start of the recession. I may still be right. The government, we may become obvious to us that the recession has started 3 to 6 months from now, but they may actually go back and back it up and say, actually, it started back in May or June or July of this year. Now, obviously, it's not going to be perfect, but when we start looking at the data, it's not just the yield curve inversion you need to look at. You also need to look at other factors that are signaling a recession, and the labor market is a huge one. We are seeing not just bad numbers out of the labor market, but the worst thing we're seeing is government revisions. In fact, we just had the biggest revision from the Department of Labor since the 2008 financial crisis. And that revision was 818,000 jobs. This is a huge number. And so that means that the government, which previously said that we had created a certain number of jobs within the economy in the last year, they just revised those numbers down by 818,000 jobs. That's a huge revision. In addition to that, we're also looking at the JOLT, the job openings report, and the JOLT data is not looking very good either. This particular data actually looks at potential jobs going forward, and we're also seeing big gaps in job openings are really crashing. At the same time, some of those jobs in the labor report are still there, so there may be actually additional revisions going forward to the unemployment data, and so I am worried about the labor market. I'm watching it very, very closely. Other factors that you really want to look at are commodities prices, specifically things like copper and oil. And so copper, they often refer to this on Wall Street as Dr. Copper. Copper, oftentimes the prices kind of predict what's going to happen with the economy because so many products and so many things have copper in them. Copper is a major commodity that's used in so many things, and when the price of copper starts falling like it is now, it is a bad signal, especially when we have so much copper supply in the world that is being reduced. You would think that copper prices would be hitting all-time highs with some of the supply that we're seeing come offline, and they're going down. So this tells you that the demand is dropping even faster. We're seeing the same thing in the oil market. Oil was $80 plus for a very long time, not too long ago, and now we're down into the high 60s on the price of a barrel of oil. Normally, when you have big conflicts in the Middle East and other places around the world, you'd think oil prices would be even higher. Well, we're not seeing that. Oil prices are actually dropping in the face of these conflicts that we're seeing around the world, which is also a recessionary indicator. One other factor we want to keep an eye on is volatility, and what we're actually seeing in the markets. The stock market has been extremely volatile. We've been seeing big drops followed by big rallies. The market, every time it drops, it seems to rally back up. And the Wall Street loves this, right? The market is strong. Everyone's partying on Wall Street. Even though we're seeing this bad data out of the labor market, the stock market just keeps going up and everything's going to be great. We want to be very, very cautious on this volatility. I am concerned about it. One of the things that I think that is keeping the market up is what's going to happen next week on September 18th at 11 a.m. California time. We're going to get the Federal Reserve rate cut decision. And I say rate cut decision because I do believe it will be a rate cut. Everyone is talking about whether it's going to be a quarter point or a half a point rate cut. I do think the Fed's probably going to lower a quarter point, 0.25%. I think they've signaled that. This is the market expectation. I think if they cut a full half point, 50 basis points, I think this will be very negative for the markets. I think the market participants will say, wait a minute, what is the Fed seeing that is so bad that they got to cut rates by a full 50 basis points? So I think we're going to get a quarter point. Now, my personal belief is this is a huge mistake. I do not think looking at the data, the inflation data, looking at the producer price index, and especially the small business reports that show small businesses' number one concern is inflation and all the extra prices that small businesses have to pay for everything from interest rates to taxes to labor and of course commodity prices. So they're worried about their business because of inflation, and so it doesn't make a whole lot of sense to lower rates when we still have all of these inflation indicators. But I do think that it will happen, and the stock market is anticipating this, and the idea is the Fed's cutting rates, everything's going to be great. It's going to cause a boom in the stock market. When rates are lower, stocks do better. So we're going to see this big boom. But once the Fed does cut rates by that quarter point that I expect, then I think that'll probably sober up the market and say, what's next? and I don't see a whole lot of good data that's going to cause the market to continue to go up. Now, it could go up. Obviously, we have no crystal ball. We don't know what's going to happen to the market. We definitely want to take advantage of the fact that we know that over time the market goes up. 74% of the time the market's going up, 26% of the time the market's going down. So we know that 5, 6, 7, 8 years from now, the market is most likely going to be higher, at least on a nominal basis, but we definitely want to be way more cautious right now. We want to hedge against risk. We want to protect our accounts, which is what we're doing for all of our clients. We're thinking about ways to protect your principal because I think the recession probability is much higher, which obviously leads to a potential market drop. The probability is much higher. So we want to protect you from that. The next thing I want to talk about is the Kamala Harris economic plan. And I mentioned Trump's economic plan in the last market update. If you haven't seen that, you can look at the description below and find that video. And so today I'm going to cover some of the highlights on Kamala Harris. Unfortunately, we don't have a concrete economic plan. There's just some things that she's mentioned and talked about. So I certainly will cover those and what I think on an economic opinion. Certainly, there's other reasons why people will vote for one candidate over another, things outside of economics. So I'm going to really just focus in on some of the economic plan that we see. And so the first thing I want to cover with her plan is the elephant in the room, which is the whole idea that the grocery stores are price gouging and that we need to rein in the greedy corporations that are price gouging. And so this is absolutely ridiculous. If you look at grocery stores' profit margins, they are extremely low. In fact, historically, grocery stores' profit margins are 1.9%. And so if you go pay for $100 worth of groceries, the grocery store is actually only making $1.90 on average from that transaction. It's a very competitive market, very, very slim margins. They operate, it's very interesting where they put everything in the store. The milk and the eggs are at the back of the store because they make no money on those. They want you to walk past all the chips and cookies on your way because they'll make a good profit margin on that. And today, if you look at actual grocery store profit margins today, they're at 1.6%. So these companies are actually making less money than they have historically. And so this whole idea of price gouging is really ridiculous. And this isn't a partisan issue. This has been done by both Democrat and Republicans in the past. This whole idea of price gouging actually stems from the fact that most people don't understand the difference between inflation and rising prices. Everyone seems to talk about today inflation automatically is rising prices, but that's not true. Inflation is an increase in the money supply, which results in higher prices. And this is really important. They're not the same thing. Inflation is an increase in the money supply, which is what's happening with all of the government deficits that they're running. And of course, Trump had large government deficits. Obviously, Biden has even larger government deficits. And what we're seeing from both economic plans from Trump and Harris is also large deficit spending. So this inflation in the money supply is what causes prices to go up. So it's not the greedy grocery stores, it's not the greedy gas stations that are rising prices. It is the government that is inflating the money supply that results in higher prices. So understanding that, when you start talking about the government, they don't want to blame themselves. See, the increase in the government spending is the reason we're seeing these increases in costs. And so by conflating the two together and saying, oh, inflation is just rising prices, then they can say, oh, well, look, the person who's raising prices, the grocery store, it's their fault. They're the ones that are raising the prices on you. But that's not how it works. That's not how economics works. And so don't get confused by these politicians. And like I said, it's not a partisan issue. In fact, if you look back at history, price controls have been tried twice before in modern American history. The first time in the 1900s was actually Franklin Roosevelt during the Great Depression. They tried price controls. It was an absolute disaster. They destroyed perfectly good food. They destroyed all kinds of perfectly good eggs and chickens in order to keep the prices from going down. This is absolutely ridiculous, but this is what was happening with price controls. They were trying to prevent the prices from going down too much to actually help the farmers. Now, of course, the opposite happened in the 1970s with price controls with Richard Nixon. Richard Nixon actually was a huge problem. This was a huge disaster when Richard Nixon, who was a Republican, he set price controls in place. They killed 1 million chickens. They did all these things and caused all these food prices to go up. And the reason is they were trying to set prices and they just couldn't deliver to the market at those price controls. So it created all kinds of problems in the economy. Even in the fuel, people had to go on Monday or Wednesday or Tuesday or Thursday to get gasoline because they had price controls on gasoline. And it was an absolute disaster. Every economist will tell you that what Richard Nixon did in the 1970s is the worst thing you can possibly do. And so is Kamala Harris serious about price controls? I don't know if she's serious or not. I don't know if she's just trying to play to whatever people might want to vote for her. But this is really a ridiculous policy. Price controls long term end up in situations like Venezuela and Soviet Union and empty store shelves. And let's talk about two other proposals that she has that I simply think are not realistic, that are not going to work. One of those proposals is to give people $25,000 to help them buy a house. And this sounds great. We're going to help young people buy homes by just giving them $25,000 to help them with the down payment. But this is really economic ignorance. At the end of the day, giving people $25,000 is just going to cause the price of houses to go up by $25,000. It is not going to help anyone. What you have to do if you want to help people buy homes is you have to increase the supply. You can't just give people money because that increased demand and the same number of homes are there. That's a problem. Now, a lot of these economists will say, well, there's a projection that there'll be 3 million new homes that are built if this $25,000 is available because these various companies, but that's not how it works. The prices are simply going to go up. So actually, Bobby Kennedy Jr., who was recently dropped out of the race, had a proposal that actually may have really helped. This is a proposal where people could get money through Fannie Mae and Freddie Mac, some of the government-sponsored entities, where they could get loans at a below-market rate, at a lower interest rate, if they were first-time home buyers and were looking to buy a house. That could actually spur some real development. But I would go even further. If you really wanted to help younger people buy homes and potentially drive down some of the expensive costs to buy a home, what you would do is you would actually do the same proposal that Bobby Kennedy Jr. had, which was lower interest rates, special financing, government sponsored loans at lower rates, but you would only offer it for new homes that fit a certain criteria. Maybe it was a smaller home, a starter home, and it had to be brand new construction. Now, this would be a smart proposal because what that would do is definitely encourage builders to buy new homes so people could take advantage of these lower rates, and potentially you could even offer down payment assistance like Kamala Harris is recommending, where you could say on these new homes that are built, there's an additional $25,000 the government is going to supply. And so in that situation, you would create growth. You'd create more houses, which is really what you want. If you want to make homes more affordable, you have to increase the supply. You have to grow the number of homes, not just the demand. Which brings up another proposal that she has, which is $50,000 to help small businesses get started. Now, this proposal would be $50,000 available for someone starting a small business. The problem is this is going to be a complete waste. the majority of small businesses actually fail. And when people are just out getting loans to start small businesses, most of that money is going to get wasted. You really, really want to make sure that someone who's going to start a small business really can't just get a bunch of free money. They have to do their homework and their due diligence and really make sure that this small business is going to work. And just giving people free money away, it's going to make it so they're not doing the kind of due diligence that they should in order to start that small business. Furthermore, we've seen free government money to small businesses is absolutely abused. We saw that with the PPE loans. What happens is people will start businesses, claim all these things, get all this money from the government, and a lot of it's fraudulent. So it'll just be fraudulent. There'll be companies claiming to start a business that are really not starting a business. They'll submit fraudulent paperwork. They'll get the money. And of course, this is a huge deal. The IRS is dealing with this right now. Millions and millions and millions of dollars went out to really fake companies, fake things with these PPE loans. And I'm afraid that would probably be what would happen if we started giving $50,000 away for creation of new businesses. Now let's talk about a couple proposals that Kamala Harris has that actually would be very, very good. Let's talk about the first one, which is extending the child tax credit. This is a proposal that actually helps young families with young kids, a $6,000 tax credit for people that make under $100,000 a year. And so this is a positive. Now, obviously, tax credit is a giveaway of money. You got to find a way to pay for all of this. The way that Kamala Harris says she's going to pay for it is raising taxes on corporations and raising taxes on capital gains, which we'll get to in just a second. But as far as a child tax credit, I do think that as a society, it is important to help young people get started, especially young people with young kids. It's tough for them to get started. I know I was in that situation at one point in my life, and I'm sure many of you were as well. So the child tax credit is definitely a good decision. I believe economically, it will certainly help the economy, giving those people a tax credit. Now remember, a tax credit is applied to taxes that you have to pay, which means that you can't get the credit unless you have income, that you're out there working. So this is a really good thing. It's encouraging productivity. So this is a smart move on the tax credit. The other area that is a smart move is the no tax on tips. Now, of course, Trump already announced that he wanted no tax on tips, and it looks like Kamala Harris has adopted this into her platform. This is a great idea. I covered this in the last video. Taxing tips makes absolutely no sense. At the end of the day, if a business gives someone an income from employment, the business gets to deduct that on their taxes. That's an expense. But if you tip someone, if you go to a restaurant and you're paying your meal and you tip someone, you don't get to deduct that on your taxes. That's not fair that someone else has to pay a tax on something you don't get to deduct. So it really is a gift. It should be classified as a gift. And so tips should not be taxed. I covered that before. And so that is a good economic strategy. The other one that Trump had, which I really liked, was no tax on Social Security income. We have heard absolutely nothing from Kamala Harris on taxing Social Security income. And so it doesn't look like that is a proposal that she is offering. But that's another one that I think makes a lot of sense. People are paying tax going into Social Security. It does not make any sense for them to pay tax coming out. Furthermore, all these people in retirement collecting Social Security, if they're not having to pay tax on an income, is definitely going to help spending in the economy because those people typically spend all of the check that they get because they're in retirement. Now, the other proposal that Kamala Harris has is increasing taxes on both corporations and capital gains taxes. And so this is how she would pay for a lot of the additional programs for giving $50,000 to small businesses and $25,000 away for first-time home buyers. And so this is different than Trump's proposal. Trump's proposal was tariffs. He wants to actually increase the taxes, which is quote unquote a sales tax on foreign made goods. So he wants to have higher prices on goods made outside the United States versus goods made inside the United States to help promote jobs in the United States and to make things made outside of the United States more expensive. And remember, we are paying that tax. It's not China paying the tax. You hear that, oh, China's going to pay and Germany's going to pay and Mexico's going to pay. That's not true at all. In fact, the American people are the only ones going to pay that tariff, going to pay that tax. It's going to cause the price of foreign-made goods to go up. Now, I'm not entirely opposed to this because it will promote people to buy goods made in America. It will promote American jobs. And so the tariffs, as long as they're not targeted tariffs, which can create a trade war, as long as they're across the board tariffs, I think that is a good decision. Now, that is quite a bit different than what Kamala Harris is proposing. Her proposal is that she wants to increase taxes. Now, the corporate tax rate is currently a flat 21%. This is what corporations pay in taxes. Trump actually wants to leave it at 21% and then lower it to 15% for made in America. So companies that are making things in America, they would get a tax break from 21% down to 15%. Now, Kamala Harris just wants to raise the corporate tax all the way up to 28% across the board. So there's a big differential between there and the corporate tax. And it's important to understand what a corporate tax is. Corporations don't eat, they don't need to sleep anywhere. They treat corporate taxes as an expense. This is no different than any other expense, as far as wages, expense for new equipment. This is an expense for the corporation. So when you raise corporate taxes, all that does is increase the cost of the goods that corporation sells. So essentially this is inflationary. It's going to cause those companies to have to raise the prices of their products. So really, I'd like to see corporate taxes come down. Corporations are not people. People end up paying taxes from corporate profits separate, personally, on their own, from dividends or a K-1 distribution if it's a pass-through corporation. So those taxes are being paid at the individual level. So taxing corporations is really a mistake. It just causes prices to go up. And so corporate taxes at 28%, I think is quite high. I think that is probably a net negative for the economy in general. It will also probably have companies that want to go outside the United States to incorporate. We saw obviously a lot of companies during the Obama administration move outside the United States to Ireland and Dubai and all these other places to incorporate. And a lot of those companies decided to bring a lot of money back with some of the stuff that Trump did when he was president. And so a low tax rate actually helps jobs. It helps companies create things here in the United States. And so increasing the corporate tax rate to 28%, I think, would be a pretty negative thing for the economy. The other thing that Kamala Harris wants to do is increase capital gains rates. They're talking about a 28% capital gains rate, which is far less than the 44% that Biden proposed, which is a lot better than the 44%. But the current capital gains high rate's 20%, so that'd be an 8% increase. If you're in Florida or Texas, that 20 to 28% is not going to have a huge impact. But when you're in a state like California, where we pay income taxes, and California doesn't recognize capital gains, it's just income as far as they're concerned. And when you have a top rate here in California above 12%, if you take the 28% that would be the capital gains at the federal level under Kamala Harris, and you add in the 12%, that's 40% tax. That means that every time you have an asset that goes up, which is stocks or real estate or anything that you own, it goes up in value. When you sell it, you have to give almost half, 44% of the profits to the government. That is really not good economic policy. In fact, that would encourage the government to create more inflation, because the more inflation they create, the more those assets go up, the more capital gains taxes that you would pay. So in general, I am opposed to these higher capital gains rates. Obviously, we didn't hear anything from Trump about increasing or lowering capital gains rates from the current numbers. Currently, they're 20% is the top, and most people are going to be paying 15%. And so looking at the current capital gains rates, I think they're probably in a good spot. Increasing them to 28% would probably be a mistake. Now let's talk about the actual products we're seeing now that we are very happy and excited about that are being offered for our clients. The first thing I'll talk about is the multi-year guarantee annuities. The current rates that we have held. I don't know for how much longer. I have a feeling, especially with the Fed potentially cutting rates next week, that we will see these come down. The current 3-year guaranteed interest rate is 5.25%. The current 5-year guaranteed interest rate is 5.02%. So we're still hanging on with those rates. I have a feeling that those could change as early as next week. And so we will probably see some reduction in interest rates with what we're seeing in the secondary market and what we're seeing in the fixed income markets. And so that is the guaranteed rate. Similar to a CD, what you see is what you get. You put your money in, it's guaranteed. There are some advantages with these MYGAs versus like a CD in the bank, because you do have the penalty-free withdrawal access. You can get a 10% of your money every year during the term, which is nice. Also, the gains grow tax deferred, so you actually don't pay tax on the interest till you actually draw it out. Unlike a CD, you're going to get a 1099 at the end of every year. You have to pay tax whether you draw the money out or not. So there are some advantages there. The other product that we like a lot is the buffered index portfolios. Those have just done so well for our clients. They're a way that you can invest in the stock market with a lot of insurance protection. As you remember, the previous ones that we had was a 20% cap with a 20% insurance policy. The new ones that we have available this month are a little bit different. We have a 24.5% cap, which sounds great. It's even higher, but we actually have insurance of only 15% on the downside. And so the insurance is a little less, the cap's a little bit higher. It is a net negative by 0.5% when you think about it, because if you had a 20% cap and you can make up to 20%, but you have a 20% insurance policy, now a 24.5 cap with a 15 insurance policy, we're losing about a point there. And remember, this is a dual directional policy, so in the event that the returns on the S&P 500 are anywhere from 0 to 24.5, you get the whole thing. If the market's up 20, you get 20. If it's up 24, you get 24. If it's up 40%, you only get 24.5. So that's your cap. In exchange, you get a 15% insurance policy, but it is dual directional, which means that if the stock market starts dropping, you actually get the inverse return. So if the market is down 10%, not only do you not lose money, you make 10%. If the market's down 15%, not only do you not lose money, you make 15%, but it is a 15% guaranteed reimbursement. So if the market was, say, down 25%, you would actually still be down 10% because you would only get reimbursed 15% of that 25% loss. So these are great accounts, they're great contracts. I think that you definitely should take a look at them. We're doing these for a lot of our clients. One other option that we have, which I've been splitting a lot on these, is we do have a buffered index portfolio that has no risk. And so this is a great option for people that are more risk adverse. This one has a 22% cap, so you can make up to 22%. Same deal, goes up with the market. If the market's up 10, you get 10. If it's up 15, you get 15. If it's up 22, you get 22. If the market's up 40%, you're only going to get 22. This one is not dual directional. You do not get an inverse return. In fact, this one, you just get your principal back. So if the market is negative at all, it doesn't matter if it's down 10 or 15 or 20 or 30, you get your money back. So this is a great way that you can make 22% over the next 2 years with no market risk. You actually get your money back. Now, of course, you don't get the potential. If the market's down 10%, you can actually make 10% on the first option. So one of the things that we've been doing for a lot of people is splitting these recently. In the event that you have a buffered index maturing or you want to do a new one of these, oftentimes we'll put part of the money in the one that has the dual directional option, and then we'll put part of it in the one that has no market risk. So you can participate in the market and have some great insurance protecting you on the downside. Now, there is a third thing that we're looking at that we like a lot. We have a brand new product available. We're excited about it. It's actually being released next Tuesday, so I'll have all the details next week on this. And this is a modified endowment contract, which is a really interesting insurance policy. It's a life insurance policy. And this one is really, I've been waiting for this to happen because they changed a lot of the rules in the life insurance world. I was expecting a good account to come out like this because of the rule changes, and we are getting it. It's a fantastic account with a great insurance company. And the way it works is you put in money that's not IRA money. It has to be cash money or after-tax money. And this money actually, you get a 12% bonus on day one, and it is a premium bonus, which is fantastic. So your account value jumps up by 12% on day one. And the underlying return, if you go back in history, looking back decades, has been 6.3% on a historical return. So it's got a great return metric. There is no risk to your principal. In fact, if you look at the illustration, it shows that you can actually pull all of your money out plus some after just 1 year. So you're not really locking your money up too much. And it does have a great liquidity feature. If you held on to the account, you actually can get access to 80% of your principal on a tax-free basis in what's called a policy loan. But the other thing about this life insurance contract, modified endowment contract, that's so great is it provides two things that our clients are oftentimes very interested in. One, it provides a nice death benefit. So there is some life insurance associated with this. For someone who's say 60 years old and puts in $100,000, they'll probably get over $200,000 in life insurance right out of the gate. Also, it provides for long-term care insurance, which is great. Both of those are tax-free. So if someone puts in $100,000, they might qualify for $160,000 in long-term care benefit. That gain is all tax-free if it's used for long-term care. And this is someone that's losing 2 of their 6 activities of daily living. This is like eating and dressing and bathing, those kind of things. And so if you lose 2 of those, you get a nice bump in the value. But the account's going to grow over time, and you have access to income if you need it. You can pull money out. It is a modified endowment contract, so the interest is taxable if you pull it out to spend it. If it's used for long-term care or it pays out on a death benefit, it is 100% tax-free. So this is really a nice account. It has a nice high potential return. It's got a nice bonus on it. So we are going to be talking to select clients that look like this is a good fit for them. And if you'd like more information on this, we will have it available next week. Pretty exciting product that's available. It's been a long time since we've had some really good life insurance type investment products, and so I'm excited about it. Now, this is life insurance, so you do have to qualify medically. There is about 20 questions or so that we have to ask you. And if you answer yes to any of these, they're kind of knockout questions. So basic things, do you have HIV? Do you have cancer? Have you been in the hospital in the last 2 years? These are the kind of knockout questions. As long as the answer is no to all these big things, it's got very simplified underwriting, and a lot of people qualify. The ages for this is going to be anyone from about age 50 up to about age 80. This is going to be a really good possibility for those people. For younger people, I'd probably rather go with Index Universal Life to potential for more growth. You don't really need the long-term care as much. And for people that are above 80, you simply cannot qualify for this account. The 80 is the maximum age that they will underwrite the life insurance for. So that said, we're very excited about a lot of this stuff that we're seeing in the market. Of course, on the stock side, we are focused heavily on moving from growth to value. We want safer stocks. We want companies with good dividends, good PE ratios, good value. You're seeing that in the Copley Tactical Fund, which has performed very well. Another area that we're still focused on, which we have large positions, is gold. It continues to hit all-time highs. This is what I expected. And by the way, this is not a good sign for lowering interest rates. Typically, gold is a great barometer of inflation, and when gold prices are hitting all-time highs, probably not a good idea to be lowering interest rates. I think this is probably a mistake. And so long-term, I think gold prices will continue to do very well. It's a great inflation hedge. In the short term, I think gold has gotten quite high. I think there's a high probability that gold pulls back at some point in the next few months. We'll see. It could pull back to as low as maybe 2380, somewhere around there, 2400 range, before the next big jump up. I do expect gold prices to be higher next year than they are right now, but we could have a temporary pullback. So I hope that was a good market update, and I hope you got a lot out of it, and I look forward to seeing you in our Mission Valley office very soon.